It's 2 a.m. in New York, and Dave is staring at a euro-dollar chart that hasn't moved 8 pips in the last hour. He read that Forex trades 24 hours a day, so he figured any hour was a good hour. 2 hours later, without changing one input on his strategy, the same pair rips 40 pips in 20 minutes. Dave didn't get smarter. The clock changed. We're taking apart exactly why the hour you trade Forex in matters as much as the setup you trade, starting with the overlap that was quietly running in the background the whole time. Forex never closes Monday through Friday. Tokyo hands off to London, London hands off to New York, and New York hands back to Tokyo to start the loop again. But the market isn't equally alive the whole time. Liquidity, how many buyers and sellers are actually standing at the table, swells and shrinks depending on which cities are awake at the same moment. Dave's 2 a.m. candle was quiet because only a thin slice of Asian desks were even online. The real question isn't whether the market is open. It's whether anyone with size is actually in the room, and that only happens when sessions overlap. There are 2 moments each day where 2 major sessions run at once. Early in the Tokyo day, London traders start arriving for their morning, and for roughly 1 hour the 2 sessions sit side by side, thin but not empty. Later, London is deep into its afternoon exactly when New York opens its doors, and for close to 4 hours both sessions are fully staffed at the same time. Same word, overlap, 2 very different rooms. One's a quiet handshake, the other's rush hour. Which one do you think moved Dave's chart at 4 a.m. New York time, and which one was still asleep? Here's the number that should reset how you think about this. The London-New York overlap alone can account for more than half of all Forex volume traded that day, and on active days, traders estimate it pushes past 70%. The Tokyo-London overlap, by comparison, is a trickle next to that. More desks open at once means more resting orders, more competing quotes, and more size clearing at every price. That's liquidity, and liquidity is the actual engine under everything we're about to cover, not the clock, the crowd. Watch what that crowd does to price. During the quiet Tokyo stretch, candles stay small and ranges stay tight. There simply isn't enough disagreement in the room to push price far. The moment London overlaps New York's afternoon, candles stretch out, wicks get longer, and moves that took 6 hours overnight can happen in 20 minutes. This isn't randomness, it's supply and demand getting crowded much faster. Pause for a second and guess. If Dave had waited those 2 extra hours instead of trading at 2 a.m., would his stop have gotten hit, or would his target have? Remember, context beats the pattern, the stop is what saves you, and nothing replaces practice on a live chart.